So here I'm going to go over the complete analysis on one of our quick analysis sheets for one of our multifamily properties. A lot of people ask me questions about this and try to understand how exactly to analyze a multifamily property. And obviously things have changed in this kind of a market as far as interest rates and different strategies like that. But what's important to understand is there's an easy way to do this, to be able to fully understand all of your costs involved, because so many people miss their costs when they're analyzing multifamily properties. And so I'm going to take you through this and show you some of the strategies that I implement and how I break some of these things down. And we created a quick analysis sheet to make it easy so that a lot of people submit us, when they submit us deals, we know that they're good deals. We know that, what we're looking for from a cash flow and equity position standpoint based on the amount of work that we have to do and things like that. And so, obviously the first thing that helps out a ton when you're analyzing property, and I'm going to the sheet right now and I'm screen sharing, so hopefully you guys can see this okay, but I'm just starting with this acquisition summary right here on the left side here. And what we're doing is we have the property address, we're putting that in detail. We want any pictures. We got to get the rent roll so we can do a proper analysis and understand when lease dates end and how long it's going to be before we can bump them to market or get them out of the property, because those types of things matter from a timing perspective on a scale like this. If you're dealing with larger apartments, you have to go through and understand when are your rents going to be increased to market and how long is that going to take. Do you have to move people out, or are there certain ones that are already vacant that you can upgrade at that time to move them forward? Then you also want to understand what the current financials look like, which you can't put a whole lot of reliance on the current financials, but what you can do is see and understand basic expenses. Are there revenues on a monthly basis when you're looking at their month-by-month financial equal to or close to their monthly rent rolls? How much delinquency are they showing? What is their insurance and property tax amounts, even though you can't rely on insurance or property taxes in their numbers, because property taxes are going to be based on your acquisition value and insurance is going to be based on your cost basis and also your risk tolerance basis. I've seen insurance companies consistently come in, sellers come in with really low insurance premiums on their pro formas, but their basis, which is maybe half of what we're buying it for, because they've held it for a long time and they never increased their insurance values to what current market value is anymore. And so you start to see some major discrepancies there. You pretty much have to get your own insurance estimate there. And so you're comparing what that looks like and what they're telling you versus what you think is real, because 95% of the time those are wrong, or they've taken out key repairs and things like that, or they've said that, hey, instead of repairs, we're going to put it as Capex that comes in, which in some cases is valid, of course, if you're doing a roof or plumbing or electrical, but they can throw a lot of those things into those costs. And so you've got to come up with your own estimates here about these costs and not just look at their numbers. And so looking at this from this scale, just as an example, I always want to ask for the current financials if they're available. And you're starting off with your purchase price, which is kind of the number you're going to back into, just like when you're analyzing a single family home property, you typically back into your purchase price after your profits come in. You look at what your sales price is minus selling costs, minus all your other costs, your rehab and closing costs and interest and everything else, and your profit, and then you find out what your price is. So in this example, I just put it at 600,000. And so looking at this, we have 8 units that need full gutting, 10 units that need mid rehab, and 10 units that just need cleanup, because there's different stages of rehabs based off of each unit individually. There's units that have already been maybe rehabbed in the seller's eyes, but aren't really rehabbed in your eyes, or don't have major systems done and just have cleanup, lipstick to make it look nice so they can get a tenant in there, but appliances are old and they need new countertops, the water heater's old, the HVAC system is shot, all of those types of things that kind of go into it that add to that rehab, because a proper rehab is all major systems fully finished, so that way you can get an even cash flow stream going forward. And if they're not finished, you may not spend the money right away. If you have an AC unit that's got 14 years on it, but it's still running strong, you don't necessarily want to go and replace that right away, but you want to put the rehab money aside for this. So when that item comes up, because you know it's about to come up, you have the money and you have an even cash flow stream into the future. So all of those other big ticket items, those preventative maintenance items, you know, a lot of people forget about the rehab amount on this and forget about how much of you know, those things cost if they don't not needed right now. And it's important to allocate those and build your Capex that's going to be coming up in the future, and just throw it into the rehab as what you're going to need for renovation, because you're going to either need it right now for the rehab or you're going to need it for the Capex reserves afterwards, and holding those funds aside. Okay. So in this case, just as this example, I have, you know, an interior gut rehab of 30 grand, mid rehab of 16, and cleanup of 8. Some of these numbers can be completely wrong depending on your deal in itself. And so you want to be able to go through and outline these. And so we have a rehab tab here that we've kind of developed, and it's a little small. I apologize for that. Let me see if I can't increase the size here of this sheet. And I'm not seeing it. So anyways, so looking at this, you have exterior, you break that down, you have a gut rehab and all the major items there: painting the interior, the carpet and floor, the tile, the wood, any repairs, the bathroom and kitchens, appliances. All the major systems are outlined here, and you can say, this is what I think it's going to cost for a gut rehab, this is what I think for a mid rehab, and this is what I think for cleanup, just to get a general idea. Now, if it's a small enough unit size, you're not dealing with 300 plus units, you may be able to go through and actually break down the exact rehab bid by unit in detail, so that you can get a better estimate versus just kind of categorizing the units, right? But an initial analysis, you're kind of just going to categorize the units and get as best of a detailed bid as you possibly can. And you're separating the interior of the units from the exterior of the buildings as well. And so you want to look at your roof, your siding, your gutters, your painting of the exterior, the yard or fence work, plumbing, electrical meters, the rehab management fees, rehab buffers in place, and other. And normally I recommend right now at least a 15% rehab buffer on your renovation, just because of inflation costs and things like that that are consistently coming up across the board. And whenever you're doing a renovation, there's always items that come up consistently on your renovation that are unexpected. So going back to this analysis sheet, you know, we start off with our renovations here of 30 grand a unit times 8 times 10 and times 10. If we're looking at 28 total units here, just in this example. And so that comes up with a total cost plus your renovation of $616,000 in renovation costs across all the units. Plus you have your purchase price, plus you're going to add 15% in overhead. You're coming up with about $708,000 in total renovation costs. Okay. So all you're doing in this acquisition summary is coming up with your total costs of the project. Okay. Then you're going to have, and these numbers are not accurate. They depends on your building, how big the building is, how big of the project. Is it a small building? Is it is the inspection going to be how many units? Are they doing a sampling? You know, all those types of things matter considerably when you're analyzing these properties. And so obviously, you know, legal fees, inspection costs, any environmental studies that you have to do are important. Getting a survey and an appraisal, much more expensive on a multifamily building than on a single family. And keep in mind, all these prices are probably higher now. I developed this spreadsheet a little while ago, and there's been inflation in the market. So keep in mind, you want to understand what these are in your market. The legal fees in California versus the legal fees in Tennessee are going to be completely different. You want to be calling title agents to try to find out, what are your general fees that are typically these things cost? Call survey companies, call appraisers, call the environmental study companies, and find out what these costs really are, so you can get a cost estimate. Because the biggest thing that you need to understand is you don't want to ever have to go back to investors and ask for more money on these. You want to be very conservative and really dial in your numbers. And so, you know, if my legal fees, if I thought they were going to be 2,000, I might put them at 4 in this kind of situation, just to be conservative, because something may come up on the project, right? Same thing with inspections, environmental studies, and everything else. You have lender legal fees and lender points involved if you're getting a financing on there. You have any miscellaneous costs, or there could be some tax prorations and things like that that come up as well. You have your insurance costs as well that are going to go into this, your closing costs, any other due diligence fees. What if you have to pay a team to go out and do a lot of the due diligence for you on these projects? So obviously some of these things you're just estimating up front to see if a deal even pencils in the first place. And so you're not going to go out and get all this data right away, but you should start to be able to dial this in the market that you're working in slowly as you're analyzing deals, or once you get one under contract, you're dialing these numbers down in detail. And then we have, you know, your acquisition fees and things like that. You know, if you're syndicating or operating this, you have a lot of fees and time that go into this that you might want to go and charge the project as a whole. So from my perspective, looking at this, it's really important to make sure you have these extra fees built in. Now, from the lender perspective, they want to see 6 months of interest. They want to see 6 months of your property taxes. You're going to pay the entire insurance up front, and you want to have your Capex reserves, which are not relative to what true numbers should be on this in this particular. This is just an example. So I'm just filling in numbers here to come up with our total cost. So now we have our purchase, we have our rehab of 708. We have about 37,000 of other costs, and then about 70,000 of reserves. Okay, so now we have our total costs of the project built out on this for the most part, excluding some other miscellaneous items that, you know, I may not be thinking of just for this simple example. Okay, now typically I'm buying in primarily cash flow markets. And so I like to target a 7 cap on the back end of my property as far as my exit sale cap, especially if cap rates are not going to be compressing. If they get a little bit looser because interest rates went up, stuff like that, then you really want to make sure you have a proper cap rate at market value versus loan rate ratio there, so that you're cash flowing well enough. That's one of the reasons why I target a 7 cap, so that if I'm borrowing at a 5.5% to 6% multifamily rate at some point in the future, then I'm still in good shape to create a decent cash flow for myself and my investors. If you don't do that and you target like a 5 cap or a 6 cap or something like that, and interest rates go up, your cash on cash return is absolutely horrible. And that happens in markets like California or Arizona recently, or some of these other higher markets that have gone up like crazy. In California, you're looking at 4 caps and things like that in a lot of cases. And so they just don't pencil from a cash flow standpoint. And so then they're more volatile also when there's changes in economic volatility that happens, and changes in interest rates that occur. So very important and key thing. Sales commissions we put in there at 6 to be conservative. Hopefully we get a little bit less on the back end. We're looking for a stabilized cap rate at our cost of about 8% on our money, which may be difficult to do in this kind of a market, may be a lot easier to do as we go forward if there's some reduction in market values or some better cash flows to show up in multifamilies, or someone hasn't raised their rents in a while, because rents have gone through the roof. And so if you find projects where the mom and pop owners own these buildings and they haven't raised their rents, then you can absolutely, you know, improve to a much higher rental ratio. And so, but backing up those rents are really, really key. Okay, so I typically look for a 15% plus profit margin. So that means after I sell the building, minus commissions, minus closing costs, minus all my costs involved, I'm making at least a 15% margin for doing a $700,000 renovation. That's very reasonable. That's just the bottom line. I want to look for more than that if I possibly can. But at the end of the day, based on market rents and what my after repaired market value is, I want to see a 15% equity margin. So if I need to sell this, or if there's a change in the market and my market value drops, or rents drop, or financing goes up, I'm well insulated from any changes like that in the market that are the biggest risks that I see for multifamily right now. So in addition to that, equity cash flow requirement, I'm typically targeting a 10% cash on cash return for my investors on the capital that they're making. So they might get a 7 to 8% preferred return with a split afterwards in favor of investors. In this case, I put it at a 70%. I put the preferred return at 8 in this example with a 70% split to investors afterwards. Usually there is that 70% split, maybe even to another hurdle rate, like a 10% or 12% cash flow return, and then a 50-50 split after that. That way, the operator is incentivized for performance with the investors, and it's a lot easier to raise capital for your deals. You're protecting the investors and saying, hey, I'm not going to get paid until the investors make a certain amount of money every month on their money, okay? So, and you can choose to add an asset management fee involved in this so that way you see what that looks like, because you might have some expenses that are reoccurring that you want to get paid for as you manage this project, okay? So now let's go over to the income summary over here, okay? And what we're doing is we're analyzing what are the current rents versus the stabilized rents. And so you're pulling the rent rolls and you're saying, hey, I have 10 units that are rented for 600, 3 units for 700, and a one bedroom, 1 bath, 8 of them for 425 a month, which are severely under rented. And here's my market rents, which what you're doing to pull these market rents, which a lot of people fail to do correctly, is they're pulling specific comps. They're looking at MLS comps, they're looking at apartments.com, they're looking at Zillow, they're looking at Redfin, they're looking at every data site you possibly can find on rental comps. And then you're calling property managers, you're getting other data reports in the market as well. And then you're saying, let me back up my comps analysis, because your property value is massively tied to this. And so from that perspective, it's very, very key to be able to go through and get this dialed in detail, because your investors are going to ask about this. If you don't have backup in your area of comps for your same approximate square footage, for your same approximate type of asset, meaning the amenities on the asset is an A building, a B building, a C building, as well as the quality of renovation and the area, these are all things that you got to be considering, just like you're comping out a single family homes, market value, that type of stuff. So very important stuff to do when you're analyzing these is backing these up with comps in detail so that way you have the right numbers, okay? And so then I take their trailing 12 financials and I go put in what I see as their actual expenses based on those trailing 12 financials. And what you can see is there's a lot of differences between their numbers and what your projected figures are. Based on their numbers, it's producing about $196,000 a year minus a 10% vacancy. Admin, legal, marketing, repairs and maintenance, you can see are very low, for example, and this is very common that I see this on the pro formas. Landscaping, property management, payroll. If you have a big enough building, you're going to have payroll involved, and you'll have a lower management fee to compensate for that to a degree. Taxes, in all the utilities, you're going to want to back these up as you go through due diligence to make sure those numbers are correct, and you're able to check those with the actual statements that came in the to the owner, and you're requesting those as part of your due diligence package, because many times they're completely wrong across the board on the utilities. Capex as well, and then insurance, okay? So right now, this is showing a 9.5 cap property, and is what it's showing at our cost. If we were to buy this for this cost, and minus debt service makes about $65,000 a year. But at our market, this is what we really care about, what our market is, okay? We're saying, hey, we're going to add another 11,000 of other income. Maybe it's late fees, pet fees, those types of things that you're adding. You still expect a 10% vacancy allowance to be conservative. And you're going to come up with your actual numbers here for marketing and admin and legal, and repairs and maintenance at a very minimum are $75 to $100 a pop per unit per month is what you guys should be computing for your repairs and maintenance. In my opinion, we used to run management companies. Repairs have gone through the roof recently. Don't expect on a 26 unit building that your repairs are really going to be $4,000 a year or $50 a month per unit. 75 is not really that conservative when it comes to repairs and maintenance. And it also depends on your Capex and what you've done there and how much you put into that too. So, and then landscaping, you're going to get quotes from your landscapers. You want to look at your management fees. You're going to bump up the property taxes and call the property tax assessor's office and understand how they reassessed. What's the formula for reassessment? How do they determine that and when? So you can get an accurate estimate of what your new property taxes are going to be after the renovation occurs and after you acquire that property. You're going to look at what your true utilities are. You're going to look at, normally we put $350 to $450 a unit per year in replacements and Capex costs, depending on the building. It can be different if you have a 5-building portfolio versus 1 building. Think about the roofs associated with that type of property alone, or the plumbing on each one of these buildings separately, completely different scenario. And so understanding those things matters. And the way you back that up is you say, hey, I have this many roofs, I have this many AC units, I have this many water heaters, this many windows, this many everything, right? And you say, what's my useful lives of these items? And what's the cost of those items? What are those costs going to be 5 years from now when I have to replace them, assuming a typical 10% inflation rate or something like that? That means they might be 50% more. And there you're going to divide it by the useful life you have remaining to come up with Capex for just roofs or Capex for just HVAC systems. So those are the things that you're really going to be focusing on when you're building your Capex to come up with this cost per unit that you're going to input here. And then your insurance, you're going to get a new policy quote from your insurance agent that gives you the full balance of your or the full amount of coverage you want. If you're buying this building, right now you're looking at 600 plus another 700 plus another 125,000 there, or $100,000 there. You're looking at a good chunk of cash that you might be needing to increase your insurance to. So understanding what your total cost is and what the true market value is afterwards is important, so you know what your insurance coverage is going to be. So this equates to operating expenses of about 87,000, net operating income of 166, monthly of 13, which is about an 11 cap in this example, of course. So, and I've bought these at 11 caps before, by the way, upon renovation. So then you have your preferred return, which is automatically built in here based on your 8% preferred return, and then net cash flow after that, and then your investor splits, coming up with a total return to investors of 18% cash flow return in this example. And then you see what your cash flow split is. In this case, it's a little high just because of the fact that I put in the numbers that way to look at that. And you can look at what your exit cap rate is here. If I put this at 7 for my exit cap, then I'm looking at a value afterwards of about $2.38 million, on this exit cap for here, and I'm looking at about a $463,000 value add, according to this, once it's at a 7 cap. Now let's go over to the final piece, and this is the analysis summary. So we have our total cost here, which comes up to about 59% of the after repaired value at a 7 cap. Okay, these are valued based on these cap rates. Okay, minus commissions, closing costs, which should be a little higher than $5,000 on a $2.3 million building. Obviously, I'd probably put something like 20 in this case. And if you are going to get financing, it's 75% of your total cost here with a construction loan, which it could be 70 or 65 in this case. And this spreadsheet specifically actually asks you, do you want to get financing on the rehab too, or just your purchase price? If you put just your purchase price on this, then it changes the loan amount down to 75% of the $600,000 purchase price. And that's important to understand, just because sometimes your rehab is 50 grand and you don't really want to finance that. You just want to deal with the purchase and get a long-term loan from the start. Okay. And so then we have an amortization period here of 25 years. I put a 5% interest rate. It may be a little higher or a little lower depending on your project and your market. And so the first position loan is 981, which is 41% of the market value here. So that's 75% of your value, your cost involved. So they're not going to go above your 75% of cost typically in these types of situations. Sometimes they might go a little bit higher, but most of the time they're not. you're going to need to raise 434,000 on this, which is the difference between your all-in cost and your financed amount. And you're looking at about a 34% margin. In my quick analysis sheet, I have this where I've broken it down into, here's your total ROI on equity, here's your stabilized cap rate at your cost, and your profit margin involved. So I hope this helps you guys understand. Obviously, you want to put your key metrics the way you want them to be able to analyze for your deal and what you think you're comfortable with and what your investors are comfortable with as far as your, assumptions here about cap rate and all those types of things. And you may be less conservative than I am. I would suggest being as conservative as possible in these situations. So thanks. I appreciate it. And I hope this helped give you a good analysis of multifamily assets and how to analyze them.